Kitco Mining special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.
Will 2024 be the year of the junior resource investor? This is Paul Harris of Kitco Mining at the Vancouver Resource Investment Conference. Joining me to answer this question today is Joe Mazumdar and Brent Cook with Exploration Insights. Gentlemen, welcome to Kitco.
Thank you.
Good to see you again.
Now, we're going to have a pretty interesting conversation, hopefully, and perhaps a little bit controversial if our pre-interview conversations go by. 2023 was a tough year for the junior sector. Commodity prices are relatively good, so why is the junior sector suffering so much?
I think basically no one's interested. There's no one, I just say no one, but there's no new real money coming into the sector. And it's just not happening. I mean, most of the money that used to come into here is old and they're retiring or dying.
In that order.
Usually in that order. And then, in my view, the younger people coming into the investing sector, they invest what they know in, which is high tech and that sort of thing. So there's not a lot of new money coming into this. That's my opinion. I mean, the commodity prices are good. There have been some really nice discoveries, but as usual, most of these companies, they die eventually because they don't find what they're looking for.
Joe, anything to add to that?
Yeah, I would add that it's probably more sentiment is negative, and as Brent pointed out, I mean, if you could make 25 to 30% in an index on the U.S. market, why bother with speculative investments? And the other one would be that what was driving gold price wasn't interested in gold equities, which was central banks drove up gold price, even though real rates were going up. And real rates, the direction of real rates is what people invest in gold in normally, and what the spillover into equities, which didn't exist. And the leverage died as a consequence as well.
Well, let's perhaps get a little bit controversial now, because if we're in a situation where there aren't new investors coming in, the existing pool of investors are not investing, what are the IR people doing to try and find new pools of capital? Are they doing enough? If they're not, if there are no pools of capital, why aren't we seeing more companies getting rid of their IR people to save costs?
Well, this seems like a bit of a purge on IR people, so I'm not going to get taken down into that tunnel. What I will say is that at Exploration Insights, during the latter part of last year, we were getting new subscribers, and a lot of these people were new subscribers, not only people coming back thinking that the worm's going to turn, but I talked to a new subscriber on the east coast of the States that was interested in the gold sector and the mining industry because they made a lot of money off of tech, and they were thinking, well, the next most undercapitalized sector was this one. And when I asked him, well, how much money did he have to invest? This guy was talking about $200 to $300 million. And so I thought, wow, that's interesting. Here's a generalist coming in. And then a couple of days ago, I had a phone call with a family office in Singapore that also was saying the same things, but these guys, when they say small cap, they're saying $1 billion. So they're way off of coming into the junior. When they say junior, it's much bigger cap. And there's not a lot of those companies to pick from. So they're going into the ETF, they're going into your Newmonts, and then a little bit lower. But they wouldn't be in this sort of environment.
He makes a good point, and I should take back sort of what I said before. When at the Beaver Creek Precious Metals Conference, there's a presentation going on. I asked the question to the audience, how many of you, is this the first time you've been here? And probably a third of the audience raised their hand. So to Joe's point, I think there is, bigger money starting to look at the sector. But as you said, there, anything under, really 100 million is like two micro cap.
Because we have the problem with liquidity in our sector, because we're talking about sectors where they can trade millions of dollars a day, whereas, they can't even do a private placement because it would kill the company and they would own too much of it. That problem existed 2 or 3 years ago, but it's only gotten worse. You know.
It's often said that, the companies they want the institutions because they're stable investors, they're long-term investors, but it's the retail investor that really drives the share price. And
Drives the trading, absolutely. Yeah.
But it's the absence of the retail investor that is perhaps one of the things really killing the junior sector.
I'd say two things. One is the lack of institutional equity. Those funds have all been shrunk or disappeared because the family offices are taking money away from them and investing in ETFs. So they don't have to pay them the fee, they get the leverage, they just don't get a dividend. But those institutional equity ETFs are not funding the private placements. So there's not a lot of private placements being done because they're not anchoring them. And then on the other side, the retail, as Brent pointed out, the age thing, and it's not like people are not interested in speculative investments. Last year, probably they weren't, except for Bitcoin, which was looking forward to the ETF, weren't really any reason. A highly speculative industry was a question mark. It wasn't just the resource sector. But now I think there's this push to potentially see about the resource sector because of the undercapitalization and the value divergence between the commodities and the equities. And that's where people see the potential opportunity. But again, that liquidity problem is making them wary of where they put that money.
A lot of last year, gold price hit all-time highs in many, many currencies, many major currencies. Yeah. And towards the end of last year, early this year, it hit that record price in US dollar terms. But it didn't open a new financing window. Why do you think that is?
Well, I really follow the trend of real rates, but not the absolute number. It doesn't have to be positive or it doesn't have to be negative, but directionally, there must be a direction saying, okay, it's going positive or it's going negative. So when it was trending and everybody was thinking real rates were going up as the Fed was in a tightening cycle, gold was only supported by central banks. That's why gold was up about 13% last year. That money does not spill over into equities. So no, that sentiment was still negative about equities. Over the last bit of last year, when people thought that peak rates had peaked, basically the real rates had peaked, that's when gold started moving. But over the last a week or so, that real rates have been flat. And so now gold is just meandering. And until they see that real direction, if there are going to be any cuts, how many there are, because already people are changing their forecast for the amount of cuts this year, because at one point people were saying there was going to be 6. And now the probability for a cut in March has gone down to 50%, when before the end of the year it might have been 90%.
So this is the catalyst that's out there, but we don't exactly know when it's going to occur
exactly.
And to what extent it's going to occur.
Exactly. And we need that trend to be in the investor's head, that it is going down, it's worth owning gold, and that would spill over into equities.
Well, there's an absence of investors generally in the space. One group of investors that are seeming to ramp up their activities is the major miner companies. We're seeing more strategic investors in juniors starting to happen. Is that good or bad for the sector?
My view, I think it's great. You look at a company like Hercules Silver that made that discovery in Idaho, copper discovery. Barrick Gold came into that with, $25 million, I think?
Pretty much straight away.
Straight away, just like that. And Joe went down and looked at the project and such, and so, we know a lot about it. But what that tells me is Bristow up top is saying, look, I want copper, I want a new discovery, and I want it in a reasonably safe jurisdiction. Go find me something. And that's what they're doing. And there's talk of Barrick buying First Quantum. I don't know if that will happen or not, but no, the majors, I think, putting money in is a good thing, because they're real shareholders. And plus, as a junior, you don't have the depth, technical depth, that the major can bring to us. So you bring a junior in or a major in like Barrick, you're going to get access to their smartest people as well. I think it's a great idea.
Yes, I absolutely agree. But the thing is that usually what a retail guy would want would the knowledge that if Barrick or whatever company was in it, they'd done a certain level of due diligence. Nowadays, I'm not always convinced that happens when they do the private placement. But the private placement for the company is great because there's no fee. Usually it comes with no warrants, and usually it's at the money or a slight premium. So all those tick the box with respect to going to the market, and if you can get them in the equity and not the project level, that's even better. So you keep 100% of the project and you control the news flow.
And it's not just in the gold space where this has been happening. In the nickel space in Canada particularly, there's been a couple of landmark transactions, let's call it that, recently with Canada Nickel and FPX Nickel getting some big investors coming in from the elsewhere in the nickel supply chain. Again, I imagine that's hugely positive. And those were very significant premiums.
Yeah, and one of them was Agnico, I believe, going into Canada Nickel.
Well, I was thinking after that you had Samsung coming in.
Yes. Again, I mean, some of these companies are looking for output, and they've had money to throw around. So a lot of these companies, that investment that seems like a quantum of capital for the junior is for them throwaway money. Let's get in early on an offtake agreement. Or there's also some politics around critical minerals in Canada, which would drive companies to do that. That might not have anything to do with the asset. So I'm not convinced of the viability of some of these nickel projects because some of these people have invested in it. It's good for them in terms of the financing, in terms of the cash in, but I'm not always convinced on the due diligence or whether that makes the project any more viable.
We're also seeing this in the copper space as well, notably Solaris Resources getting, $130 million from Zijin Mining.
Yeah, I think that's more of a statement that they want copper, and these Chinese state-owned companies, though Zijin is listed, I still call it state-owned, and most people do as well, for the right reasons, is that they're looking for copper. And now, jurisdictionally, they're more challenged because, okay, I can't go maybe to North America anymore. There's other countries that might want to sell their copper into the supply chain under the new Inflation Reduction Act into the States, and suddenly I can't own 25% of that company. But there's other jurisdictions that'll let me play. And Ecuador, they've already, not Zijin, but another company, a Chinese state-owned company, has Mirador, and they just got permitted for their extension to the north. And so they know they can operate in Ecuador. And so why not try this project, which is an open pit, decent grade, but for me, probably not blow me away grade for being in Ecuador grade, but definitely an asset that, looks like it could be built.
I think it's interesting to reflect on the different approach of different companies. Zijin wants more copper. It's buying into Solaris Resources, which is already a resource stage company with the Warintza project. Barrick also wants more copper. It's also getting into Ecuador, but it's struck an exploration joint venture with the state mineral company, Inami. Very different approaches to try and tackle the same problem.
I mean, it's probably because the Chinese state-owned company is more comfortable putting the capital in, whereas Barrick isn't. But they're very fine putting in whatever $5 to $7 billion into Pakistan. So different strokes for different folks.
Interesting. Okay, one of the key, the mega deal last year that everybody in the gold space that everybody was looking at was Newmont and Newcrest Mining. That has now happened. Newmont is now digesting Newcrest. A lot of people were saying that Newmont said it wants to divest $2 billion worth of assets or obtain synergies with that value. And a lot of people said that's perhaps put a lid on M&A activity in the gold space until the market knows what Newmont's going to keep and what Newmont's not going to keep. And now that we're starting to get some line of sight on that, do you expect M&A in the gold space to accelerate this year?
I don't have any idea. I'll be honest with you. I mean,
We're waiting for that.
yeah. Okay. Yes. Definitely, it's going to accelerate. No, I do think there are more companies out there that are just not looking at the stuff Barrick's got, but all sorts of projects. And yeah, there's a need for these projects. You look at the major mining companies' production profile; they're almost all going down. Is it right? And you know a lot about Newmont.
Well, I mean, I was doing this thing in LinkedIn, and sometimes there's a conversation, like very few times there's a conversation worth actually diving into. And one of them was about all-in sustaining costs. There's a friend of ours, Ron Stewart, that put out this graphic about all-in sustaining cost margins and how they're actually shrinking. You know, the gold price is doing fine, but the all-in sustaining cost is actually just following the gold price. And sometimes it's eating into it. And so margins is an issue for companies. And then the other thing is that the leverage that these companies supposedly have to the gold price by increasing their reserves. So a couple of years ago, Newmont had their gold price at $1,200, and they showed a sensitivity. So if they increase their gold price by $200 an ounce, you know, they might be able to go from 92.8, 93 million ounces to over 100. You know, and I thought, wow, that's good leverage. But in reality, when they changed their gold price, they were basically flat, if not for the acquisition of 100% of Yanacocha by buying out Buenaventura and another partner. Otherwise, they would have been flat on their reserves, even though they raised the gold price $200. So the companies are having trouble selling that idea. And I also told you about the issue with leverage, just on the gold price with the margins, but also with sentiment. So they're having a hard time attracting people to say, hey, you don't want the gold, you want to buy me. There's still an issue there. And right now, with them divesting and showing I've got cash, and this is an accretive acquisition, that still has to go to how do I prioritize these assets? Where does the capital go? Because Newmont's got to understand the Newcrest assets. And then after that, it will be producing assets, which will be first off the block. And that's what most intermediates want. They want the producing assets, not the developing assets.
One of the big pushes from the major gold producers in recent years has been to show generalist investors, the serious companies, 10-year production profile outlook, so they can plan and appeal to generalist investors. But given that share prices haven't really responded to higher gold prices, are generalist investors not buying that concept? Are they preferring ETFs or physical or just something else entirely?
Well, I remember when I worked for Newmont, Barrick had put out a 5-year outlook of gold production and EBITDA, which nobody did. And we only did guidance for a year. And so we were forced to do the same thing. And then when I looked back at that, Newmont never hit their production schedule, but Barrick did. But the only way they hit their production schedule and their EBITDA was buying Placer, because Placer had a lot of growth projects, which Barrick didn't have. So the synergy between that M&A was excellent. And if companies make synergistic M&A that are accretive, they'll show value. But if they just get bigger to get bigger, that might not always end up being what investors want.
And it really hasn't worked.
Yeah,
for the most part.
And as well, it shouldn't work.
Yeah.
You know, what they're doing is consolidating G&A, like with Goldcorp, shutting down their offices in Vancouver, you know, consolidating exploration programs, and then potentially with the Barrick joint venture on Nevada, that had so much money tied up in processing plants where you were sending ore halfway across Nevada because you couldn't send it next door. And when you could do that, you could change your cutoff grade and suddenly you could produce more. So that synergy in itself was just a huge release of free cash flow. If companies can find that, it definitely is worth it. And I think we will see more of that on the junior space as investors demand it, like your Adventus deal with Luminex in Ecuador. You know, nobody has a problem with Ecuador because they're already in both companies. They're all 100% Ecuador, but let's cut our G&A. Let's prioritize where the money actually goes. I could see a lot more of that happening.
Okay. Brent, you presented earlier today. What were some of the things you were talking about?
What I attempted to do, without pissing people off too much, was go through how I look at and evaluate a project, a company, and a discovery. And so I went through the company, the setting, the geology, what I was seeing and why, and what I expect over the next week actually, and then further down the road. And so that's sort of what I went through. Yeah. Do you want to know who it was or what?
Carry on. Yeah. What do you guys like at the moment? What don't you like at the moment in terms of some of the exploration discoveries you've seen?
Well, I mean, because of the issues with financing, I've invested in companies that are actually doing the project level financing with earn-ins, like Headwater Gold or Inflection. That way, when you do miss, because a lot of this stuff is grassroots, you have a concept, you drill it, and maybe the alteration looks good, and you're getting close, but your spacing is huge, but it's a technical win. That technical win would not get funded in the current market or ever. But with money from a outside strategic investor that understands geology, that program could still get funded. There's a more of an underlying commitment to see what's there. And so there is definitely sort of a move to do that. And definitely grade, infrastructure, metallurgy, all those things that would set because everything is getting valued very cheaply. And so if I can find all those ones that tick the box and still have that, a sentiment devaluation, those are the ones I will grab.
Yeah, I mean, I still own a bunch of junior exploration companies, but the divergence between the metal price and the share prices in the intermediate sort of company makes that such an obvious place to buy. Like we own Arizona Sonora Copper, I-80 Gold. I mean, they've got legitimate, really nice projects, and I think they're selling at a discount. So, kind of moving into that middle range I am.
Yeah. Yeah, and then also, I mean, you think about permittability, you think about water, you think about, all these things, not just grade, about will this actually work and will it attract an M&A or can it get built by the people that are actually running it? So those are the sort of things that if they're trading at steep discounts, I could see this changing,
Well, one key word there would seem to be patience then. Let the project's good, the philosophy is good, the thesis is good. You need to allow it the time to gestate, to realize.
Yeah, and so, when I sold companies last year, some of those companies were down 50 to 60%, and another company that might have been down 40 or 50%, I kept because I still thought it had the opportunity to turn around. Whereas the other ones I was more worried about because the other problem is cost of exploration. So if we're talking $1,000 per meter and you have to keep going back to the market to fund 2,000 meter programs, in a small timeline, that's not something I'm interested in. I would rather have somebody that, there's more bang for buck on that meterage, and so that's another consideration.
And patience is a good point.
Yeah.
Patience equals cash in the bank. If the company doesn't have cash in the bank, it's unlikely we're going to keep it.
Yeah. But the thing is, it's not only cash in the bank, it's access to capital. So knowing management could actually find $5 million in the market if they needed to. I mean, regardless of what the share price is doing, but there's somebody out there and then just now they just don't need it.
Okay, well, that brings us in towards perhaps this final question. What would you think is a healthy, reasonable investment strategy for people at the moment?
Well, I can tell you what I am. I mean, barbell approach. I've got a bunch of stuff in T-bills and such, a little bit in mid-sized companies, and a bunch in juniors. But I wouldn't recommend that for everybody. I mean, this is my specialty, right? Everybody's different.
Yes, I've heard that. Are you talking the overall portfolio of your life?
In the resource space.
To feed the children? Or
in the resource
in the
space.
Resource space. Okay. I didn't know where we're going there, So, yeah, in terms of being called exploration insights, buying a Newmont or a Newcrest, unless there's a big catalyst coming up and it's a short-term thing, doesn't make a lot of sense. But there's definitely the severe devaluation or the undervaluing of developers that make sense, that have resources, that should be acquired, that maybe the stalling is waiting for the divestment of the Newcrest-Newmont merger. But as soon as that's gone, this will be one, that makes absolute sense to me because retail doesn't like development plays. So as soon as they get into a scoping study, then they're done. They don't like the de-risking, and that takes a little bit more patience, but that's something that's probably more likely to happen.
Okay, well, Joe and Brent, fascinating conversation. Thank you both very much for joining us today.
Thank you.
Thank you.
And this is Paul Harris with Kitco Mining at the Vancouver Resource Investment Conference. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.